Now, growing up, I don't feel like I got a good understanding on what credit was and why it's important. My parents mentioned that they had good credit in passing, but seeing as I had no idea what that was, I never really cared. I mean, if it was that important, they'd teach me in school, right? Now I've come to understand that credit is absurdly important, and the fact that kids are never formally introduced to the idea is absurd. Credit is an invisible force that can dictate where large chunks of your future earnings will be spent. I used to think that if you used a credit card, you were actually being irresponsible by not just paying for everything up front with the money that you actually have on hand. When I started making my own money, I wasted a lot of time using a debit card only. I was lucky enough that my parents added my name to a bunch of my loans and stuff that they helped pay off, so I was able to start out with a decent credit score, but I wasn't doing myself any favors by not building my credit history. I just recently kept my brother from making the mistake of paying for a car up front in cash, which he likely thought was a prudent idea. There's a lot of simple mistakes you can make in life just by not knowing how credit works. And it's scary because your credit can take a hit without you knowing until you finally decide to look it up, and the damage is long done by then. So, what is credit? And what's a credit score? Credit is kind of how it sounds. How much credit should a borrower give you when deciding how likely you are to pay back a given loan? This is a huge, because whether you realize it or not, there's a lot of things in life that you'll end up financing with loans or otherwise being screened on the basis of your creditworthiness. Unless, of course, you're starting off rich, in which case, lucky you, I guess. I'm talking about things like financing higher education, if you're taking out private loans, the interest rate on your auto loan, the interest rate on your mortgage, whether a landlord will rent to you at all, getting better credit card deals, and some employers, controversially, have been known to look at modified credit reports during the hiring process. Cell phone companies can screen your credit before offering you certain plans. Banks will generally look at your scores before they let you open an account with them. And how much do you think they'll make you pay to insure your car? Your credit score factors into a lot of these things. And like, for instance, that car payment, that's another monthly, potentially non-negotiable cost that you have to pay. Now, let's just agree right off the bat that these costs can add up to a massive amount. In your head, you probably have some idea that this must be true. But what you may not realize is how big of a deal this can become. Let's just take one of these transactions as an example, your mortgage payments. A mortgage is a loan from a financial institution, typically a bank, that lets you buy a house without having to pay massive sums up front. Your dream home in a good location may well be hundreds of thousands of dollars in value, and you may be able to finance that, but only over a decade or three. As you can see from this example on myfico.com, for a $216,000 loan over a 30-year fixed-rate mortgage, your monthly payment can go from as little as $879 if your credit score is amazing, to as much as $1,071 if your credit score is at the absolute bottom of the allowable range. And by the way, there is an allowable range. With a low enough credit score, you may not even be able to qualify for a mortgage. You may be deemed too much of a credit risk. And in this example, a person with an excellent credit score is paying over $2,000 a year less than the one with the abysmal credit score. If we extrapolate that out for the full 30 years, that's over $60,000 cumulatively over the life of the mortgage. The lifetime earnings of the average American, based on a yearly average income of about $31,000 in 2016, but let's call it $35,000 to be generous, because actually at this point it is slightly higher than that in 2020, comes out to around $1.4 million. Assuming for a moment that you are the average American in 2016, that's up to a little over 4% of your lifetime earnings extra locked into a mortgage based on one number. Well, it's actually three numbers, so let's talk about that. The range for credit scores is from 300 to 850. These scores, the ones most people are using anyhow, are more accurately called Fico Scores, the Fico standing for Fair Isaac Corporation. Fair Isaac Corp introduced the scores in 1989 as an industry standard that are supposed to make things easier for both lenders and consumers. The system's really only been around for about 30 years at this point, but it's already become kind of the default way that we derive creditworthiness. Now, It's not that it's really only one way, mind you, as methods of calculating a FICO score have been updated periodically since then, and FICO, as Fair Isaac Corp is now calling itself, has introduced many alternative scores since then, like FICO Auto or FICO Bank Card. Who actually comes up with these scores? Well, there's 3 credit bureaus that are in charge of this, and you've likely heard of them at some point: Experian, TransUnion, and Equifax. Why might you have heard of them before? Well, it might be because you saw one of their commercials. Unfortunately, it might also be because one of them got hacked and they contacted you to let you know that all your data belong to strangers now. Personally, I relate to both of these experiences. Fuck you, TransUnion. If you watched Last Week Tonight with John Oliver, he's done episodes on credit reports and one specifically about Equifax. Highly recommended if you like an expanded introduction to credit bureaus and the various problems associated with them these days. Now, how do you know what your credit scores are? Well, there's a couple ways. First, you can buy credit scores from the 3 bureaus listed above. Next, you can use a free credit scoring site. And lastly, you can potentially find scores on your most recent loan, credit card, or bank statements, as these institutions have started providing scores in many cases. When checking credit scores, what's the difference between a hard inquiry and a soft inquiry? And why does this matter? So this kind of relates back to the idea that some people have that checking your credit score may be disadvantageous. First, you got to know that there are 2 basic scenarios where your credit score will get checked: in relation to an actual credit application and not. When there's an actual credit application involved, they call that a hard inquiry. When there's not, like for instance, when a credit card company checks your credit to pre-approve you for an offer, they call that a soft inquiry. A hard inquiry can affect your credit score, typically negatively. Too many applications for credit in a short time can be seen as risky behavior that might be seen as you trying to live beyond your means and struggling to pay. Now, to distinguish between people shopping around for a good deal, which is a good thing, versus these more reckless types, they look more negative than people applying to credit on a bunch of things than people doing hard inquiries for various products of the same type. These stay on your report maybe 2 years or so and become less of an important factor to the score itself over time. Multiple inquiries won't hurt your score for 30 days or so, so shopping around in the space of a single month isn't restricted. So this is part of how they actually tell the difference between those 2 different groups. We can take some basic lessons from these conditions. You should only apply for credit when you need it. Check your credit reports for hard inquiries and make sure you recognize the inquirer so that no misunderstandings or fraud get onto your score. Something like 20% of credit reports actually have some errors on them. So look at them regularly and make sure you recognize everything. Don't space out your shopping for loans too much, as you may end up peppering your credit score with inquiries for the near future. It's important to take a look at your reports regularly, perhaps at least once a year, and make sure they're accurate, as these are what your credit scores will be based off of. What's on a credit report? Well, first you'll see your identifying information and personal details. Then you're going to see your various accounts: student loans, mortgages, auto loans, credit cards, etc. There will be various details regarding payment history, credit limit, loan amount, date an account was opened. You'll also see all hard and soft inquiries, which will be labeled as such. They'll be keeping track of any bankruptcies or accounts that have been turned over to a collections agency. A FICO score itself, and not all credit scores you see are true FICO scores, is calculated by mainly 5 factors, each of which has sub-factors that we're going to talk about in a minute: new credit, mixed credit, length of credit history, payment history, and credit mix. So a person with a high FICO score, credit score will have a long history of making payments on credit, a history of making credit payments on time, not too much new credit or not too many new accounts, and a decent mix of credit types that they're handling the payments on well. Now, note that the percentage on this chart are kind of more averages and don't necessarily hold true for most people. Your new credit may be weighted higher given your history, and maybe you're just starting off, so payment history is weak, but you happen to have a solid job early on, so they don't dock you as hard. What's the difference between a credit report and a credit score? Well, credit reports, of which you're entitled to a copy from each bureau every year for free, don't necessarily have your credit score on them. If you open an account with Equifax, they will give you up to 6 free reports per year. When we talk about new credit in the FICO score, we're looking at 5 things. How many new accounts in the past 12 months and the proportion of these accounts that comprise your total, your recent credit inquiries, how long it's been since you last opened a new account, how long it's been since your last credit inquiry, and the reappearance of a credit on the credit report of positive credit information for an account that had earlier payment problems. So there's a few caveats in there to the idea of new credit being bad. Paying off your delinquent accounts actually appears as new credit and helps you improve your score. Furthermore, if adding new credit to an existing line of credit decreases your overall credit utilization, this can actually be a good thing. New credit typically comprises a small part of your overall credit score. When we talk about mixed credit in a FICO score, we're talking about how well you manage having different types of credit. Revolving accounts versus installment accounts and loans for various different asset types. It looks better if you have a few different types of loans and are paying each of them off on time consistently. It looks bad if your credit mix have gone up considerably in a short amount of time, as it kind of tells people that you're overspending and you can actually get denied for a loan because of that. Credit history is a big one here. A longer credit history is generally better. It shows lenders that your patterns over time and gives them a clear idea of who they're dealing with. This one's really kind of clear-cut, and it's an area that, like I said earlier, I dropped the ball on for a while. For the teenagers out there, get a credit card as soon as you're able. Seriously, even if you don't really use it much, just make sure you pay on time and don't carry a balance, and you should be good on building the length of your credit history. Amount owed is going to factor into your credit score kind of exactly how you think it would fit in. Owing more money is typically worse for you, but it's not necessarily the end of the world if you're good for it. If, on the other hand, you owe a bunch of money and you're utilizing a large proportion of your maximum credit, that's a problem. If your debt-to-income ratio is huge, like mine is after Uncle Sam helped me foot the bill for medical school, you may have trouble getting more credit or finding a place to rent. You may end up needing someone to co-sign things with you for a while if things get out of control, and who wants that? So what goes into a credit score, and what does your individual number mean? Well, the average American has a credit score around 680 or 703, depending on who you ask. So if you're below that, you are, by definition, below average, and are therefore a relatively risky person to give money to or extend credit to. Below 640 is typically what we call subprime borrower. Quick side note, yes, this is essentially what the subprime mortgage crisis was about back around 2007 to 2010. Predatory lending practices, extending mortgage credits to high-risk lenders was a big problem, although it wasn't the only factor. Around 670 to 740 is what we call the good range, which is basically when you're about average creditworthiness. Above 740 is where the really good stuff starts to come in as far as interest rates and offers. If you can get into this range, or better yet, above 800, you're likely to get the best rates for all your transactions involving credit and can save yourself, as we saw in the example earlier, tens of thousands of dollars or even hundreds of thousands of dollars over your lifetime. And you'll have access to better credit cards, which you can use for cashback rewards or travel rewards that can help you get even more for your money. Now, one thing you'll notice if you take a moment to look up your scores is that you probably have 3 different numbers. Why is that? Well, not all the same credit information may be reported to each bureau. Also, these reports don't necessarily reach each bureau at the same time. If you've applied for credit under different names or misspelled your name on a credit application, this may not show up in your reports consistently. Also, each agency will calculate your score a bit differently. As I mentioned, not all scores are FICO scores, and you may come across things like the Vantage score as well as your typical FICOs. Fair Isaac itself offers dozens of different scores like the FICO Auto score that weight factors differently. In short, your credit score is important because you can save or lose a lot of money throughout your life because of it. You don't get to opt out unless you're rich and don't really care about or need credit, so you may as well play the game. Credit bureaus calculate your credit scores based on credit reports. There's a bunch of different scores and reports. High number is good, low number bad. Make payments, make them on time, don't engage in risky financial behaviors. Simple.